Christina, let me start with you on what happened with bond yields, because they had been really ramping up. There'd been a lot of volatility. They settled down a bit this week. Is that because of a fear of recession?
I do think that it is, what we're seeing is concerns about at least a slowdown. I don't know if it's exactly a recession. I would argue that we'll still be able to avoid a recession in the United States. And one could argue that that's what the bond market is telling us. The spreads between the 2-year and the 10-year yield are still positive, even though they've flattened a lot. There's a very big positive spread between 3-month and 10-year yields, which some might argue is an even better indicator of whether or not we go into recession. So clearly pricing a slowdown, but I don't believe a recession.
So Jim, isn't that exactly what the Fed wants, is a slowdown, maybe short of a recession?
Absolutely. And so I think the softness in commodity prices in recent days has also contributed to the moderation in bond yields. And the Fed has tightened financial conditions dramatically. And all you have to do is look at what's happened to mortgage rates and the impact on the housing market that is starting to have to understand that the Fed's impact is already starting to make a difference.
Well, I wonder, Christina, we got University of Michigan consumer sentiment numbers out on Friday, and they came off a little bit, actually, on the longer term 5 to 10-year expectations on inflation. Are we starting to see some effect of the Fed, do you think?
I do think we are. I mean, but we're also just starting to see a reflection of some commodity prices, energy prices, easing a bit in the last several weeks. So I think that is reflected in it. I mean, Jay Powell even said in that FOMC press conference that there is a pretty strong correlation between energy prices, headline CPI essentially, and inflation expectations for consumers.
Jim, how much of the concern about inflation actually comes right off of energy, just straight off of energy?
I think it's extremely high. I think if you look at the correlation between gas prices and the Michigan survey, it's really high. It's the most visible demonstration of what energy costs are to the consumer. And so I think it's going to be a critical point to inflation expectations and bond yields over the next year that we see at least a flattening, if not some moderation, in gasoline prices.
Yeah, and I would expect that we see some moderation in longer-term inflation expectations going forward. And I think it's very important to recognize this is very different than what we saw in the 80s and 90s. Before those recessions, we saw inflation high, and yet long-term inflation expectations were just as high or nearly as high as the 1-year inflation expectations. That's not what we're seeing today. Longer-term expectations are well anchored or relatively well anchored, and that's what the Fed is looking for.
Jim, what we didn't have to say is, go ahead, please.
So, David, I would add that this is such an unusual period because we're dealing with these supply disruptions that are not really possible to confidently forecast. The disruptions coming out of Ukraine are still in place, and they could get worse. Russia has started to turn down the gas to Europe, and you don't know what they're going to do with that. And the agricultural season is coming towards harvest, and we don't know how they're going to get the grain out of there. So while there's a good case to be made that we will see inflation coming down, the risks around it are very atypical at this time of the cycle.
I wonder about that specifically because you heard, for example, Elizabeth Warren, Senator Elizabeth Warren this week, asking Jay Powell, the Fed chair, saying, what can you do about gas prices? Is there anything you can do effectively? Because it's not clear the Fed can do anything about those supply chain problems that Jim's talking about.
Well, the Fed can't do anything really about energy prices or commodity prices either. But what they can do, and what he said in his testimony, was that they could soften demand for things, for durable goods. And that will have some impact. So I anticipate we'll see elevated inflation, but it should start to moderate from where we are.
But can the consumer keep up? I mean, because so much of the economy is driven, Christina, by the consumer. They're spending down their savings right now. How far can they go?
Well, it all depends on exactly the trajectory of this slowdown. So we have a very tight labor market, which I think is the biggest advantage we have. And we have more job openings than we have job seekers. So theoretically, if the Fed cools demand, we could see companies react not so much by layoffs, but by removing job openings, job postings. And in that way, they could navigate a soft landing. I also think it's critical that the Fed is data dependent. I mean, and we saw that on display. It wasn't just words. The Fed reacted to essentially 2 data points and made a pivot in terms of how much it hiked rates at the last meeting. That could happen in the other direction as well. I think it's great that they're going to be reacting to incoming data. I think it enables what is a blunt instrument, not a surgical tool, to become at least a little bit more like a surgical tool.
Jim, what about currency? The dollar has been on something of a tear as a practical matter. I'm not sure how long the rest of the world can put up with that. Is there a danger of a reverse currency war here?
I think there absolutely is a major impact from that. It is going to lead to a curb of inflation in the U.S., but it's going to really hurt growth outside the U.S. and hurt the ability of those companies to service their debt. So I do think that that's got to be paid a lot of attention to. It is an important part of the financial conditions index. And so the level of strength that we've seen so far will absolutely help slow growth in the U.S. along with inflation.
So, Christina, what about those financial conditions? Jim's mentioned them before here, and I saw a chart that Northern Trust had actually showing financial conditions have tightened a lot more than they have in the last 4 or 5 rate hike cycles, actually, although I think the inflation rate was much higher this time than those times as well.
Well, yeah, and the Fed is doing what it hoped to do. And it actually started doing that with talk, which is great when talking can do some of the heavy lifting. And so immediately, really at the start of this year, when we heard that the Fed was planning on reducing the size of its balance sheet this year, that's really when we started to see financial conditions tighten, and it has continued since then. That suggests to me the Fed may be able to get away with fewer rate hikes than it currently projects, because it has done a very good job tightening financial conditions.
Jim, Christina raises, go ahead, please, Jim.
So here's a great example of the impact the Fed's moves will have. They will probably hurt GDP by roughly 1% by the decline in housing activity because of the jump in mortgage rates. Probably won't hit house prices as much, but there clearly will be a slowdown in activity because of not only less construction, but less remodeling, less broker commissions, et cetera, all tied to the fact that mortgage rates have had a historic percentage increase in the last 6 months.